Sridhar, if I look at the last declared portfolio, a big contra bet seems to be healthcare. You have a 12.5% exposure to healthcare. Now, what makes you bullish on healthcare? A, it's expensive. B, healthcare, we know, inherent Indian companies, they are still risky in nature.
Yeah, so the overweight on healthcare is based on the opportunity that we see in the US markets. So the next 2 years still look reasonably good. So people are now talking about the patent cliff which comes in from 2013 onwards. However, over the next few years, we would still see very strong growth coming because of the patents which are going, the drugs which are going off patent. So our outlook on pharma still remains strong. Plus the currency also there would be a beneficiary because of the currency depreciation.
I don't see too many infra names or for that matter capital good names in your declared portfolio, which means you're not so hot on government reforms and you are not hopeful that news flow from New Delhi will improve?
Yeah, news flow could improve, but for that to have a meaningful impact on the profitability of some of these companies, I think it's going to take a long time. Plus, these are very capital intensive businesses and these companies would constantly need to dilute to meet the capital requirements to put up all these projects. So at this stage, we would continue to remain underweight all these infra names.
So you're not a big fan of L&T or BHEL, even though for some of these top line infra names or capital good names, valuations are attractive?
We still own L&T in our portfolio, but none of the others.
What about power as well as power ancillaries? Because there again, there is some anticipation of something afoot when it comes to policy.
Yeah, I think there's a lot of hope as far as power is concerned. But I think there are enough bottlenecks as far as some of these companies, especially on the utility side, whether they will get the coal. Some of these companies are grappling with the fact that they have bid at a very aggressive rate. Now they want SOPs from the government. I'm not very sure if the government will be able to give them all the benefits that some of these private companies are expecting. So we would still remain underweight on utilities.
Sridhar, exactly a year ago when I interacted with you on the same forum, you had indicated to our viewers that you were positioning your portfolios for a defensive trade. It looks like after that your portfolio strategy has not changed because in your declared portfolio you are still positioned for a defensive environment.
That's correct. So we have not changed our stance right now and we continue to be defensive. So we have overweight on staples, pharma, and maybe the only change we would have made it increase a little bit of our exposure on the financial side. So we continue to be defensive. We think that the environment still looks very tough. The GDP is not as if it's showing an accelerating trend. It's at best flattish or has a downward trend. Inflation still an issue. So if I look at the macro situation, it doesn't give me the confidence that one needs to go very aggressive and build a portfolio which is not defensive. And also we think that this quarter results and maybe even the next quarter are not going to be very great. So one has to keep all these factors in mind.
So incrementally, what could go wrong from these levels? Because whatever could go wrong has already gone wrong. Currency is broken down. We have a sub 6% print on the GDP growth. Earnings are a bit fizzy. So what could go wrong?
Well, as I said, with all this wrong, we are still doing quite well. So that's the problem, that we have ignored all the negatives and we've done quite well. So what could go wrong is a surprise on the negative side on the results, which is highly possible this quarter because from whatever sense we've got speaking to corporates, things haven't gone that well as far as this quarter is concerned. It's possible that market could ignore it because a lot of it is already there in the price. But for the market to move up substantially from here, macro has to substantially improve. GDP growth has to accelerate. Fiscal deficit, there has to be at least some sense that it will be contained at the so-called declared levels around 5.1%. Inflation has to show signs that it is receding. And we need some confidence from the central bank that they would continue with the easy monetary policy going forward. So I think there are a lot of ifs around here. So I would say at best another 5% move for the market from here because the sentiments were extremely negative. And from whatever we understand, looking at various surveys, that FIs generally have been either neutral or underweight India. And this is more a catch-up what we are seeing right now. So another 5% and we'll struggle from there. So
if I'm a shareholder of Morgan Stanley Growth Fund, after a 5% appreciation, should I sell my units?
Yeah, if you have a very short-term view, then you need to take tactical views as far as the market is concerned. But if you take a longer, say 12 to 18 month view, it's highly possible that if the earnings for the market in general grows at say 10 to 12% or 15%, then we could see the market move up over a period of time, which is 12 to 18 months, by another 10 to 15%. So I guess each investor would have to take his own call based on how the asset allocation they're doing for the money they're investing.
Sridhar, what about mid-caps though? Do you think largely as a basket the outperformance is here to stay?
I would actually be a bit skeptical on mid-caps. So mid-caps tend to do well extremely as far as fundamentals are concerned when the economy is doing extremely well. When the economy is struggling a bit, what happens is some of these smaller companies tend to take a larger hit. And from whatever we can see in the economy at the ground level, things are not very great right now. So it's highly possible that some of these companies were beaten down and we are seeing a rally there. But for a sustained rally of mid-caps in general, the economy has to do well. And it's only then that they would show sustained outperformance. So I would be a bit careful on mid-caps.
So when it comes to the upcoming earnings, which sectors do you think are going to post extremely weak earnings, and what are the ones that you're going to be a little cautious with?
Well, it's going to be difficult to say, but I think autos in general, we already seen the auto numbers. They are nothing great. So I think that will also have an impact on margins. So I think autos will have a difficult quarter. I would say the entire infra pack will continue to show difficulty in terms of their results. Financials, depending on how the NPA cycle is playing out. So we're already hearing murmurs that the NPA, the declared NPAs could be higher, especially for some of the PSU banks. So we'll have to wait and see how it plays out. So I would say these three sectors we could see some disappointments.
Sridhar, in terms of consumer discretionary as a trade, it has been a resilient trade for the first half of this year. But do you think now cracks are opening up?
Cracks are surely opening up. The fact that we are having high inflation, high interest rates, and slowing economy all three are negative for consumer discretionary. So the fact that autos in general are struggling right now is an impact of all these factors which have been playing for over 18 to 24 months right now. And I think for this sector to recover sustainably, we would need many of these factors to fall in place. So I would be very cautious with this sector right now.
So the scenario, Sridhar, what you are building up is that it's too early to revisit high beta stocks or high beta trade. It's time to sit tight and protect cash.
Yeah, I would say it's risky to play high beta right now. I think one has to take a view on a stock specific basis, and I think a quality bias will pay over the next 12 to 18 months.
Most of your peer fund managers are of the view that valuations are looking extremely attractive. Most of the infra companies are trading below their replacement cost. You cannot go wrong at these levels. But you have a different thought, and I guess you're the only fund manager who's bearish right now.
Well, as I said, I still think there's a 5% trade from here, and with that trade we would be somewhere in the range of 15 to 18% for the year. Earnings are growing at 12%. How much more can you ask? So you're basically talking of a re-rating from here, and at best I can see macro mildly improving. So I can't see this sustaining over a period of time. So I think one has to be realistic.
Sridhar, what about the market and the expectations on the policy front? Now that the Prime Minister has taken over the Finance Minister's portfolio, do you think hopes are high in terms of what could actually happen post the presidential elections?
I think we fund managers and in the markets, we always live on hope. So when this government came, the markets were up 20% actually on hope. And we've seen what has happened over the last 3-4 years. Obviously, the hopes are still quite high. And I think there's even a marginal or a small incremental reforms can have a disproportionate benefit. We saw some announcements on GAR, but if we see a clear announcement on some of the taxation issues, those could go a long way as far as improving FDI and FI sentiments are concerned. So I don't think the government needs to do too much to improve sentiments. Marginal announcements could have disproportionate benefits as far as the markets are concerned.
So what's the best way to tactically approach this market? I mean, on a 10% appreciation, will you trim some gains from existing stocks, and on a 10% decline, will you add more to your existing portfolio?
I don't think we will need to do too much. I think sometimes you just need to have patience and just sit through difficult periods, which is why I said we would have a quality bias. So these stocks tend to outperform in falling and rising markets. So it's difficult to sit here and try and do a crystal ball gazing of what could happen in the next 6 months. We don't know what's happening in Europe. There are a number of moving parts. So I think it's safer to take a view that you pick your stocks, keep a quality bias, and as we see some reforms or as we see more announcements, then we could take more call on whether to take or change the portfolio. But as of now, I don't see any need to substantially change the portfolio or take drastic bets as far as the market is concerned.
I just want to put up your current elected portfolio: 8% exposure to HDFC Bank, 7% exposure approximately to ITC. The odd one out is Dr. Reddy, which has a 5% exposure. Do you worry about how state governments are now increasing VAT on tobacco? Eventually, that could have impact on ITC and cigarette sales.
Yeah, so I think this has been playing out for a while now. So we've seen different state governments increasing VAT. However, some of these companies have shown pricing ability to pass it on to consumers. So I would want to believe that the same would continue as far as ITC is concerned.
So what are your current contra bets? Where are you allocating disproportionate amount of money? That's my favorite question.
As I said, it's a very boring portfolio. There are no contra bets right now. So we are assuming that safety is more important right now, and as we see improvement in the macro, which currently we are not seeing, we would look at contra bets. So at this stage, we would prefer to have a defensive portfolio.
What about cement? Are you surprised with the move that the stock prices are showcasing, irrespective of the CCI order?
So I think the CCI order was expected. It was well documented. Various newspaper articles were already there. So I would assume that some part of it already got priced in. We do have an overweight position on cement, but that is more from a fact that over 2013 and 14 we see the cement capacity and demand sort of coming closer to the reality. As a result, we could see pricing eventually. So at this stage, we are not so worried about CCI because we've seen some of the other CCI cases have gone to court and we have not heard anything for over 1.5 to 2 years. So we don't know how this will play out. But in the interim, we think that over the next 12 to 18 months, cement could surprise on the upside.
When do you think the bull market will start for India? 2 years, 3 years?
I think this is more like a 94 to 99 scenario where we would see a sideways market, and I would say the starting for us is 2011. So we have another 3 years of flattish market. Sorry, I may sound a bit bearish, but until and unless the economy recovers and we have a sustained growth, this market will not be able to break out, and we would see constant negative news. So it's possible that we could see years where we could get 10-12%, but with some sustained reform measures, it's possible that India could still get disproportionate foreign inflows as we've seen this year, because the situation in some of the other countries is even worse. So if we can put our acts together, we have a possibility of having a bull market. But for that, we need to see some action from the government side, which we haven't yet seen.
I really appreciate your honesty here, because fund managers, they are rarely bearish. So what will make Sridhar the bear, Sridhar the bull?
Well, I think, as I said, if we see the macro economy recovering and we see the GDP growth on an upward trend, inflation at a reasonable level over a sustained period of time, I think these are the prerequisites for a bull market, which currently is not there. So we may, as much as I may want that the market should move up, but some of these prerequisites currently are missing. And if that be the case, it will be difficult for the market to move up on a sustained basis over a period of time.
I really appreciate your time, and thank you very much for joining us on this edition of First Trades.